Right now, SoFi Technologies, ticker SOFI, is trading live at $30.34, down about 0.95% for the session. This comes after the stock gapped down at the opening bell to $29.66 from yesterday's close of $30.63. So far, it's seen a trading range between $29.33 and $30.46 as buyers and sellers fight for direction just after the open. Now, the immediate expectation looking at that opening drop is that perhaps the momentum is fading, that the incredible run-up we saw after their recent earnings is finally taking a breather. The market seems to be expecting a simple sell the news event after such a strong report. But the reality of what's happening under the surface of SoFi is far more complex and, frankly, far more interesting than just a simple post-earnings pullback. The real story isn't just that SoFi beat expectations, it's how they beat them and what it implies about the entire business model. The market seems to be slowly waking up to the fact that this isn't just a student loan company anymore. It's not even just a neobank. It's a full-fledged, diversified financial institution with a technology-first mindset, and it's executing on that plan with remarkable speed. Let's establish the common ground, because we all saw it. The narrative for SoFi for years has been growth at all costs. It was the Fintech poster child, lumped in with other high flyers, and it was heavily debated on platforms from Robinhood to Fidelity. The expectation was simple. As long as they kept adding members, the stock would be fine, even if profits were a distant dream. The recent Q3 earnings report, however, didn't just meet that expectation, it completely shattered the no-profit narrative. The company didn't just squeak out a profit, it reported a stunning $139 million in GAAP net income. That's not a rounding error, that's a statement. They posted earnings per share of 11 cents, smashing the consensus estimate of 8 cents. Revenue came in at a record $961.6 million, blowing past the $887 million analysts were looking for. This wasn't just a beat, it was a fundamental shift in the company's story. This is the reality that the market is now forced to digest. SoFi is no longer a jam tomorrow stock, it's a profit today stock, and this has forced a massive re-rating. We saw the stock spike from under $30 to a new 52-week high of $32.57 in the days following that October 28th report. The volume on that earnings day was astronomical, hitting 183 million shares, more than double its average. Yesterday, volume was still incredibly high at over 90 million shares. Today, we're already seeing heavy volume with over 21 million shares traded in the first hour. This isn't quiet profit-taking. This is a high-volume debate as large institutions and retail traders decide what this company is actually worth now that it's a profitable growth machine. Some are clearly locking in gains, which is what we're seeing with this morning's gap down. But others are just as clearly initiating new positions, recognizing that the old thesis is broken. Let's look at the institutional activity. Recent filings show that institutions own about 47% of the company. We're talking about giants like Vanguard and BlackRock. This isn't just a retail favorite anymore. The big players are involved and they are reacting to this new reality. Following the earnings, we saw a flurry of analyst updates. Needham, a longtime bull, raised its price target to $36. Jefferies pushed its target to $35, and Truist Securities moved its target to $31. This shows that the people who model this company for a living are scrambling to update their spreadsheets because SoFi's profitability timeline just got pulled forward aggressively. However, the street is not in complete agreement. Morgan Stanley remains underweight and Keith, Brewett, and Woods has an underperform rating. This tension is what creates the volatile trading we're seeing. It's the old bearish, it's just a lender expectation, fighting against the new, it's a diversified tech bank reality. The key to understanding this shift lies in why the earnings were so good. It wasn't just one thing, it was everything, all at once. This is the flywheel that CEO Anthony Noto has been talking about for years, and it's finally spinning at full speed. First, member growth. The company added a record 905,000 new members in the quarter, bringing their total to 12.6 million. That's a 35% increase from a year ago. They also added 1.4 million new products. This is the fuel for the fire. But here's the critical part. the non-lending side of the business is exploding. The combined financial services and technology platform segments, that's SoFi Invest, SoFi Money, SoFi Credit Card, and the B2B Galileo platform, generated $534 million in revenue. That's a 57% increase year over year. This segment now accounts for 56% of SoFi's total top line. Let that sink in. The majority of SoFi's revenue is now coming from its non-lending, fee-based, high-margin businesses. This is the ultimate answer to the bears. The old argument was that SoFi was too reliant on personal loans and student loans, making it vulnerable to a recession or credit cycle. That argument is now obsolete. SoFi is proving it's a technology company that happens to have a bank, not the other way around. The technology platform powered by Galileo provides the back-end infrastructure for countless other fintechs and financial clients. It's the picks and shovels of the fintech world, and it's growing rapidly. At the same time, the SoFi Invest platform, while perhaps not as meme-famous as the Robinhood app, is a core part of the ecosystem. It's where members who came in for a loan can then open an individual brokerage account, buy Tesla stock or Nvidia stock, or put their savings into a managed portfolio, much like one might find with Schwab Intelligent Portfolios. This cross-selling is the magic. SoFi's cost to acquire a customer is dropping because once a member is in the ecosystem, they adopt more products, making each member more profitable over time. Now let's talk about the bank charter, because this is the other half of the equation. Acquiring a national bank charter was without a doubt the single most important strategic move this company has made. The expectation was that it would help them. The reality is, it has completely changed their financial structure. Instead of relying on expensive warehouse lines or capital markets to fund its loans, SoFi can now use its own member deposits, and it has a lot of them. Because it can offer a high-yield savings account, it's attracting deposits at a massive clip. This drastically lowers its cost of funds. We saw this in the Q3 report. Net interest margin, or NIM, expanded to a very healthy 5.84%. This is what separates SoFi from the SoFi of old, and from many of its fintech peers. It has the cheap, stable funding of a traditional bank, but the user-friendly tech and growth engine of a startup. This is a potent combination. Furthermore, the credit quality, the biggest fear for any lender in a high-rate environment, is holding up beautifully. This defies the expectation that a recession would crush their loan book. The reality? SoFi's personal loan annualized net charge-off rate fell in the third quarter to 2.60% from 2.83% in the prior quarter. Delinquencies are stable. Why? Because SoFi lends to a high-quality consumer. The weighted average FICO score for their personal loan borrowers is 745. For student loans, it's 773. This isn't subprime lending, it's prime and super prime. They are targeting high-income, high-achieving individuals who are resilient to economic shocks. This is a disciplined growth story, not a reckless one. So let's zoom out and look at the company itself. What is SoFi? It's a financial services productivity loop. It operates in three distinct segments. One, lending. This is their bread and butter, where they started. Student loan refinancing, personal loans, and home mortgages. This is the engine that attracts new members. Two, the technology platform. This is Galileo, the B2B API-based service that powers other companies' card and banking services. It's a high-growth, high-margin business that provides diversification. Three, financial services. This is the one-stop shop, the super app future. It includes SoFi Money, checking and savings, SoFi Invest, active and SoFi Robo-Advisor, investing, the SoFi Credit Card, insurance products, and more. The strategy is to get a member to come in for one product, say a personal loan, and then cross-sell them into this entire ecosystem of services, dramatically increasing the lifetime value of that customer. This is a model that a traditional bank like Bank of America or a brokerage like Fidelity Investments would dream of having, but they are often stuck with legacy technology. SoFi built it from scratch for the digital age. Now, looking ahead, what's the future outlook? The expectation from management is now for full year 2025 adjusted EPS of 37 cents. They've raised their guidance repeatedly. The catalyst from here is continued execution. Can they keep growing members at this pace? Can they continue to cross-sell more products? The biggest catalyst in my view is the continued margin expansion from that bank charter and the continued growth of the tech platform. As those high-margin businesses become an even larger piece of the pie, the company's overall profitability should accelerate. This could lead to SoFi being valued less like a bank, which trades at a low price-to-earnings multiple, and more like a high-growth tech company, like we see with NVIDIA stock or Apple stock. The risks, however, are real. The biggest risk is macroeconomic. If a severe recession does hit, even prime borrowers can default and loan demand could dry up. The second risk is competition. SoFi is not operating in a vacuum. It's fighting everyone. It's fighting legacy banks, it's fighting other fintechs like Robinhood, and it's fighting the big brokerages like Fidelity and Interactive Brokers. SoFi Invest has to be just as good, if not better, than the Fidelity mobile app or the Interactive Brokers